Can I explain an indexed universal life insurance policy in even simpler terms? Let's find out. An IUL is a permanent insurance policy. It lasts your entire life. It is a product, not an investment, and you're ultimately purchasing a death benefit. So when you get an IUL, you now have death benefit coverage over your head. For the policy to be set up correctly, you want the minimum amount of death benefit coverage for the most amount of money that you want to contribute. Let's say that figure is $6,000. The minimum death benefit for $6,000 a year is $100,000 of death benefit coverage. The $100,000 of death benefit ultimately does not cost $6,000. What happens to the extra money that you're contributing is it goes into a liquid cash value that earns interest based on market indexes like the S&P 500. Your cash value is the extra money you contribute minus the cost of insurance plus the interest you earn. So if the S&P 500 earns 8% this year, your cash value is going to earn 8%, but then you still have to subtract the cost of insurance from that money. If there's a max contribution, there's also a minimum contribution. In this same example, your minimum contribution might be $1,000 a year. So now you have a flexible amount of money that can go into your policy. At most, $6,000, at minimum, $1,000. As you contribute money, the amount of death benefit coverage increases. So let's look at year 10. You would have contributed, if you're max funding your policy, $60,000. Your new death benefit is $160,000, and you would have had at least $60,000 also in your cash value. Now, you can loan yourself the money in your cash value because there's a policy loan provision inside the IUL contract. I didn't mention that. The IUL, this permanent policy, is a contract. Again, it's not an investment. Now, you can loan the money using multiple different loan options. When you loan the money, you do have the interest attached to it, but if you pay the money back plus interest, the interest goes back to you. You become the bank. There are also extra healthcare benefits included in your IUL, like a critical, chronic, and terminal illness rider that very much make the point that this is a life insurance policy. When you loan money from your policy, it's tax-free because loans are debt. When you earn interest in the policy, it's tax-free because of a tax code section 72E. And I'm going to run out of time, so I hope this was helpful. Like for part 2.